So Bill Ackman sent a series of tweets a few moments ago, and I want to read you one of them, Stephen. I want your reaction. I want everybody's reaction. He's talking about inflation being out of control, but he does say, and I'm quoting now, "How does this downwards market spiral end? It ends when the Fed puts a line in the sand on inflation and says it will do whatever it takes, and then demonstrates it is serious by immediately raising rates to neutral and committing to continue to raise rates until the inflation genie is back in the bottle. Stocks of real businesses, in quotes, are cheap once again. Markets will soar once investors can be confident that the days of runaway inflation are over. Let's hope the Fed gets it right." And I guess, Sech, before I have you react to that, Steve, investors aren't confident yet that A, runaway inflation is in fact over, or that the Fed is going to get it right. So you've got two problems colliding with one another, which is why you've got such a degree of instability in the stock market, no?
That's what I was saying at the beginning of the show, Scott. But I think you have a Fed chairman that has said that he's going to be incredibly data dependent. And my sense is that the data is indicating that we're slowing rather quickly. One of the points that Josh made. So I think ripping off the Band-Aid, going to neutral, which is 235 right now, that's an incredibly large move. I think it would challenge his credibility, honestly, because he just said that we are going to move 50 at the next two meetings and then be data dependent.
I know, but isn't his credibility already in question? I mean, some are advocating, like Jim Cramer, for 100 basis points immediately. Now, whether you believe that or not, Ackman's not in the camp by himself suggesting that the Fed just needs to be much more aggressive, much quicker, and just get it over with, and the markets will adjust, and then we can move forward. Steve, what's your reaction to what Mr. Ackman is suggesting on Twitter?
Well, I'm kind of glad he's not running the Fed, I guess, right now. I think that would be incredibly disruptive, more disruptive to markets than it's been already. I think Bill, like a lot of other folks, is impatient with the process. I think Josh Brown is 100% correct. It should have begun much longer ago than it actually did begin. But I'd say this. I think it's not important that the Fed get there with the funds rate quickly. It's important that the market price in correctly where the Fed is going and bring that forward. Like I said, there's 220 points of tightening in the market. I think Bill is right in the following sense, that once we get the stability of knowing what level of the funds rate will bring down inflation, that will be the time, or slightly before that, hopefully, to sound the all clear when it comes to the stock market. I'm looking today at what happened to the 2-year. It cratered on a risk-off story right at the open, down, I don't know, it was 11 or 12 basis points on the 2-year, came back just a little bit. And then take a look at the Fed funds. I don't know if you guys have that chart that I brought along. What we're doing right now is we're pricing out a 50 for September. We're now pricing in more of a 25. You got a 90% probability or higher of a 50 in June and July, and then you come back and now the market's pricing in a 25 with a 35% probability of a 50. So that's a 25 priced in for September. And what's really interesting to me, Scott, and I'm working on this story right now, is are we settling in that the Fed needs to get to 3? That's where the Fed futures market has been. Now, Bill might be suggesting that we have to go further than that to wring out inflation, but I am seeing some stability in this 3 to 3.25 range for the Fed funds. I think if the equity market became comfortable with that, you could start to invest based on fundamentals and not fear that the Fed was going to plunge this whole thing into a recession.
Yeah.